Hey, it's Mike Lynch with AmeriFirst Financial. It's Monday, time for your Monday morning mortgage update for the week of September the 19th. Hope everybody had a great weekend, cooler weather, smell of first rain, windows open at night. Couldn't ask for a better weekend. Actually, I spent the weekend in the city with family. We went to a Giants game, went to the Exploratorium on the pier. If you've never been to the Exploratorium in San Francisco, amazing, amazing place, and ate some chowder. So just had a great weekend with family. Too bad our Giants kind of have a season that's ending on the downside, but it was great being at the game. So what are we looking at this week and what happened last week? So last week, 100 basis point sell-off in the bond market. Every week since August, and let's look at the chart here, we've seen the bond market sell off. So if you look at this graph, this is a 2-year history of the trading of mortgage-backed securities in the bond market. And this is the MBS graph. So each one of these bars here, or these candlesticks, represents 1 day of trading. And as you see, as I float my cursor over, you can see the date change at the bottom. Now, if we go back to August of this year, August 2nd to be exact, we've seen that bond market go down. And you can see that really it's traded worse. And so that means when we see the bond market go down, that means money's flowing out of that bond market. It's not being invested in the bond market, which is where mortgage-backed securities are traded, which has a direct impact on mortgage rates. So when we see the market go down, rates are going up. And we just haven't seen any improvement since August. We actually had weak retail sales last week and weak manufacturing numbers, meaning that the economy is getting weaker. And when the economy gets weaker, we typically see better interest rates. Well, one thing is countering that, and that's inflation. CPI, PPI came out last week, inflation at a 42-year high. And inflation is the kryptonite for mortgage rates. And until inflation gets under control, we're going to see rates continue to go up. And folks, it's probably not going to get better as we move into the fourth quarter. So let's talk about what's affecting rates or could affect the rates this week. I always give you 3 things, and those 3 things are one thing, and that's the Federal Reserve. The Federal Reserve's meeting for their November meeting starting tomorrow, Tuesday, ending Wednesday afternoon. They always have a press conference, and they give us insight on, are they going to raise interest rates? And if they are, how much? And really what's happening with the economy? What's their position moving forward? So this is probably the most important Fed meeting of the year. Because inflation is so high. We know the Fed has dropped the ball in fighting inflation. The primary way the Fed fights inflation is to increase the Fed fund rate. Again, it doesn't affect mortgage rates. It affects interest that businesses are charged to borrow money overnight. But when businesses are charged more money to borrow money, which every business needs money to run their business, they pass that cost on to the consumer. Everything goes up. And that slows the economy down and that drives inflation down. So this is what the Fed's doing. They should have done it last year. They didn't. And now they're playing catch up. And it's extremely difficult to do. So we expect the Fed to raise the Fed fund rate 0.75% on Wednesday. That's the expectation. That has already been baked into the market. The rates and the pricing has already estimated that to happen. Now, if the Fed doesn't raise it 0.75%, probably going to be worse for rates because it means the Fed does not take inflation seriously. If they raise it more than 0.75%, some people think they may raise it 1 point, then that could be better for mortgage rates. But the bottom line is the Fed is going to raise these rates. And that's not the most important thing about the Fed meeting. The most important thing is, what is the Fed saying about moving forward? How aggressive are they going to continue to be for their December meeting? They have 2 more meetings today, this week, and then in December. And what are they saying about the economy in the fourth quarter, in the first quarter of next year, and the second quarter of next year? What their position is going to have much more impact on rates than them just raising that Fed fund rate. So the question is, are we in a recession? Yes, technically we are. A recession is the definition of recession is 2 financial quarters with negative growth. First quarter was negative growth. Second quarter is negative growth. We all estimate that the third quarter, which will end the end of this month, will be negative. And think about this. The last time we had inflation numbers this high was 42 years ago. The median age in the U.S. is 38 years old. So if you think about kids and they're impact of inflation. It really doesn't impact kids and stuff. So you could say anybody at the age of 55 or less really hasn't had an impact of inflation in their lives. And so this is a significant amount of the population. How is inflation going? How bad is it going to be? Is it going to get worse moving forward? When is it going to peak? Some people think it's going to peak in the fourth quarter of this year, the first quarter of next year. Some people think it's going to be a hard winter, and we haven't even seen food inflation yet. It's supposed to get even worse starting in the third quarter when the growing season ends because there's been less growth or less production. So really a lot of projections about what's going to happen with inflation and the recession. And again, we're going to be listening to the Fed and what the Fed has to say about this. The other thing that the Fed's going to talk about is investing in the bond market. So we've talked about this before. The Fed invests in the bond market two ways, on the front end and the back end. Now, our 401ks, private investors, foreign investors, we all invest in the bond market. We're investing in the stock market or the bond market. They both have their pros and cons. And we know that the Fed stopped investing on the front end of the bond market in March. They've been investing billions of dollars since the recession started, and they stopped in March so they could start raising that Fed fund rate. But they were supposed to stop reinvesting in the back end in June, and they haven't done that. They've continued to reinvest. In fact, the Fed is the number one purchaser of mortgage-backed securities. That's why these rates are actually lower than they technically should be. And now the Fed's indicating that they're going to truly stop reinvesting in the back end of the bond market at the end of this month. They're going to hopefully talk about this on Wednesday and give some insight. And if they truly stop reinvesting in the back end of the bond market, number one investor in mortgage-backed securities is going to end in the end of September, and that could even drive rates higher moving into the fourth quarter. So there's a lot of stuff coming out this week. There's other data coming out that's really not going to have much of an impact. It's Wednesday afternoon that we're going to be paying attention to. Very, very significant for rates this week and moving forward. So what's our position? Locking. We've been locking since August. We've saved our clients thousands of dollars in locking. A lot of people think they can float and maybe get a better rate one day or the next. It's a fool's game to try to time the market. It's been so volatile. We'll continue to lock. If you need any insight on rates and locking and why a locking position is so important, let me know. I'll be more than happy to answer any questions that you have. If you know somebody can benefit from this video, please forward it to them. Have an awesome day, and we'll talk to you soon. Bye-bye.